Most loan files don't fail because the borrower is unqualified. They fail because the file triggers fraud flags, even when everything is legitimate. And here's the twist. Most investors don't even know they've triggered one until the deal freezes. In the next few minutes, I'll show you the hidden fraud indicators lenders scan for automatically, so your files move faster, cleaner, and without unnecessary suspicion. Now, why does this matter? Because fraud flags slow underwriting more than credit issues, more than DSCR issues, even more than appraisal delays. One small inconsistency can cause a full forensic review. We're talking 3 to 10 days lost instantly. Let's start with a real example. A borrower submitted bank statements showing deposits that didn't match the lease. Not fraudulent, just sloppy accounting. But the automated system flagged it. Underwriting paused. Borrower panicked. And the lender began digging into every line item. That's the power of a fraud flag. It changes the tone of the entire file. So let's break down the top hidden triggers you must avoid. First, inconsistent income trails. If bank deposits don't match leases, statements, P&AMP, Ls, or W-2s, underwriting assumes manipulation. Even honest disorganization looks suspicious on paper. Second, altered documents. Lenders use digital forensics. If a PDF shows different metadata, mismatched fonts, or unusual edit timestamps, the system flags it, even if the borrower simply cleaned up the document. Third, mismatch between application and supporting docs. If the application says 6 units but the appraisal says 5, that's not a typo. It's treated as misrepresentation until proven otherwise. Fourth, round number rent payments. When every deposit is exactly $2,000 with no variation, lenders question whether the tenant actually pays rent or if the borrower is funding the deposits. Fifth, non-traceable funds. Cash deposits, cell transfers, or anonymous sources are fraud magnets. Lenders need clear paper trails, preferably W-2, recurring income, or verified rent. And here's the one that catches even experienced investors. Documents submitted out of chronological order. If tax returns are out of sync with bank statements, or leases predate ownership records, underwriting assumes the timeline doesn't make sense. That's how simple it is to get flagged. So how do you avoid all of this? First, do a fraud sweep before submitting. Check dates, names, addresses, and income alignment across every document. Second, never modify PDFs. Even formatting creates digital fingerprints. Submit originals only. Third, explain any irregularities up front. If deposits came late, if tenant payments shifted, if an entity changed names, tell the lender proactively. Transparency lowers suspicion. Fourth, build a clean income timeline. Show when leases were signed, when deposits began, and when ownership changed. Underwriters love clarity. Fifth, avoid cash. Every transfer should be traceable from a legitimate source. Here's the payoff. When your file is clean, consistent, and fully traceable, lenders move 3 times faster and treat you like the kind of borrower they want long-term. Subscribe for more science-backed insights on personality and decision-making. Educational content. Not financial advice. WhatsApp no. +1 448 230 7488 phone no. +1 201 680 0991.